Social Security can be taxed at your highest nominal tax rate. So if you're in the 28% tax bracket, some of your Social Security dollars can be taxed at 28%. However, not all of your dollars may be taxed. So how does that work? In today's video, we're going to talk about how your Social Security is taxed, how some people don't pay any taxes on Social Security, and then why do some people pay more taxes during retirement because of Social Security than they paid even while they were working. Hey everyone, I'm Nick Davis, founder of Brindle and Bay Wealth Management, and I'm here to show you how to retire with calmness and clarity. Now we know that up to 85% of your Social Security benefit can be taxed, but it not necessarily won't be taxed. And so how does that all work, and what causes some of those dollars to be included for Social Security taxation while others are not included? You see, how Social Security is taxed is based on your income plus half of your Social Security benefit, and you need an IRS chart to figure it out. The Social Security website tells us, and I'm going to leave the link in our description for the video so you can read this for yourself. Some of you will have to pay federal income taxes on your Social Security benefits. This usually happens only if you have other substantial income in addition to your benefits, such as wages, self-employment, interest, dividends, and other taxable income that must be reported on your tax return. Well, I've got news for you. Other income includes your 401k distributions, your traditional IRA distributions, pensions. All of those things will cause you to have more taxation on your Social Security. The website also tells us that in order to know how many of our Social Security dollars are going to be taxed, we have to understand combined income. And it gives us an image here on their page that says, it is your adjusted gross income plus your non-taxable interest plus half of your Social Security benefits equals your combined income. So you need to understand what your combined income is and then go to the IRS chart to figure out how many of those dollars are going to be included for taxation. Let me give you an example. I'll use a fictional Melvin and Goldie. And let's say that they have $60,000 worth of Social Security benefits between the two of them. They're going to withdraw $45,000 from their 401k or their IRA that year. And they also have $15,000 in investment gains for that year. So they have $120,000 in income before tax. Now we got to figure out what their combined income is. So based on their formula, they're going to take $60,000 of their benefits and they're going to cut that in half because it's half the benefits. So $60,000 cut in half is $30,000. So we can take the $120,000 in income, we can subtract $30,000 and we get $90,000. So Melvin and Goldie would have a combined income of $90,000. That is step one of two steps to figure this out. So step two is to look at the IRS chart. And what it says is we take that $90,000 number and we go there and it says that $0 to $32,000, that means that $0 of those dollars will be included for taxation. Now $32,000 to $44,000, 50% of those dollars need to be included. So that would be $12,000 cut in half. So $6,000 would be considered there. So that would be included. And then $44,000 and above is 85%. So we take the $90,000 minus the $44,000. We multiply that times 85 and we get our number, $39,100. We add the two together, we get $45,100. So in this example, Melvin and Goldie, even though they have $60,000 in Social Security benefits, $45,100 is going to be included for taxation in their 1040. So they would then go to file their taxes, and currently line 5A says, what is your Social Security benefit? They would put $60,000. And then 5B says, what is to be taxed? And they would put $45,100. And that's how your Social Security benefits are considered for federal income tax. So how are some people's Social Security benefits not taxed? And if you think about the example we're using here, if you and your spouse have $60,000 in Social Security income and you don't have any 401ks or IRAs or pensions, then there's a really good chance that you would not pay taxes on Social Security because 60,000 divided by 2 is 30,000. That's below what the IRS says is included. So anything below $32,000 is not included. It kind of highlights how outdated some of these rules are because on that same page that gives us this information, it says, and I quote, some of you will have to pay taxes on your benefit. So it says some of you. And then when that happens, It's because of other income. This is laughable because almost everybody has 401ks and IRAs. Like there's only a percentage of our needs that are met through Social Security. So the likelihood of you having to pay taxes on your Social Security benefits is really high. Now, there is another way that people don't pay taxes on their Social Security benefits. So imagine this situation with Melvin and Goldie, $45,000 or $60,000 in Social Security benefits, $45,000 from their 401k or IRA, $15,000 in investment gains. Well, instead of taking it from a traditional IRA, imagine that they would have instead had $60,000 in Social Security benefits, but the $45,000 wouldn't have come from a traditional IRA or 401k. Instead, it comes from a Roth IRA. If that's the case, then it would have been a much different situation and they would have probably paid $0 on any of those Social Security dollars coming in for taxes. Which kind of brings up a point, an additional point, is that Roth IRAs do not trigger income for Social Security. So this is an additional benefit to having some Roth 401k or some Roth IRA because it doesn't at this time actually trigger Social Security to be taxed. So in order to not be taxed, you would have to either have no other retirement savings, no pensions, or have a lot of money in Roth accounts or Roth 401ks. Now let's talk about why Social Security benefits often cause people to pay more money or equal taxes that they did when they were actually working. How does that work? So to answer this question, you have to understand or at least admit that taxes make a lot less sense after a person is retired as compared to before you retired. Because before you retired, you understood that you were part of this progressive tax system. You can start at 10%, go to 12%, then go to 22%. And the more income you have, you know you're going to go up in income brackets. However, it doesn't work that way when you're retired because of the presence of Social Security income and other investment income. So if Melvin and Goldie, from our example, were going to take $5,000 from their IRA, and they're in the 12% tax bracket, so they would think, well, just another 12% on $5,000 is $600. But they would be wrong because when they took that $5,000 from an IRA, in addition to their other income, they also called forth other dollars from Social Security to be taxed. So 85% of that $5,000, which is $4,250, is also going to be taxed at 12%. So where we think we're going to have a $600 tax, we have $600 plus $510 from the additional Social Security money. And so we're not paying $600, we're paying $600 plus $510 in taxes. So this is one of several reasons that people don't necessarily drop into a lower tax bracket at retirement. This is what we also call a phantom tax, a Social Security phantom tax. It's an additional layer of taxes that are not just intuitive based on our progressive tax system. So I made another example of Melvin and Goldie who had a little bit more of a severe phantom tax. So exact situation, $120,000 in income, a 12% tax bracket, but they wanted to go on a $5,000 vacation. So they were going to pull an additional $5,000 out, and the phantom tax wasn't 12%, it wasn't 22%, it was 50%. So what they thought was going to be a $600 tax bill turned into a $2,500 tax bill. So they pulled $5,000 out, but only got to keep $2,500 of it because of these phantom taxes. It surprised them when tax time came around because they hadn't figured for that extra phantom tax. So if you want to take this lesson a step further, check out the video where Melvin and Goldie paid a 50% phantom tax. We call the video Social Security Phantom Tax. I'll link it here so you can watch that and see how it happens so that maybe you can help to reduce or avoid these types of situations. Hey everybody, Nick Davis here. Thanks for watching. If you enjoy this, please consider subscribing. Also, if you would like to see the way that we help people master their retirement money so that they can go on to that next phase with calmness and joy, take a look at us at brindleandbay.com.